Hi, I'm Adam Thurgood, Managing Partner of Hightower, Las Vegas. Now, we manage 4 different strategies at our firm that we mix and match in order to help our clients achieve their financial planning objectives. And the purpose of this video is to dive into the dividend focus strategy. Now, the dividend focus portfolio is a value-based income approach that is really meant to serve as a companion to some of our more diversified strategies, such as the optimized portfolios or Defender. And we use 4 main asset classes in the dividend focus portfolio. The largest by far are high quality large cap companies. They can be both US and international. And we use preferred stocks and real estate investment trusts to help enhance the yield, and then also add in some infrastructure plays to round out the risk profile of the portfolio. Now, we use a filtering process to help us identify whether companies are a good fit. And if a company passes on these 3 metrics, then we take them to the next stage of the process. So let's dive into each of these metrics in a bit more detail. The first metric that we want to focus on is free cash flow per share divided by dividends per share. When a company operates its business, it produces cash flow. And if that cash flow is in excess of the dividends per share, then those dividends are more likely sustainable. We want to avoid situations where cash flow is less than the dividends, because that would mean that the dividends could be at risk. The second factor is return on equity being greater than the cost of equity. Return on equity is a financial measure that looks at the earnings of a company relative to the equity on the balance sheet. And when this is greater than the cost of equity, or how much it would cost them to raise equity capital in the markets, it's an indication that they're efficiently running their business. And then finally, dividends. We want to focus on high quality companies that are producing sustainable dividend streams, of course, but the yields also have to be high enough. Or they need to be aggressive dividend growers, because sometimes those companies can add a lot of value to the strategy. So if a company passes on all 3 of these metrics, then we take them to the next stage, is where we're looking at the financial strength of the business. You know, debt is a big deal. If you have too much debt, then when the economy gets rough, it can really put the business into a difficult spot. So we are looking for companies that have strong financial strength. And when we pair a strong company with a sustainable cash flow stream, we believe that we can create a portfolio that will sustainably produce dividends for our clients over the long run. Now, Peter Lynch, who's a very famous investor, has said that dividends are like rewards for patience and loyalty, a tangible expression of a company's gratitude to its shareholders. And while this is a bit hokey, we do believe that dividends are important. Sometimes, for long stretches, they can provide the majority of a return in a portfolio. So by focusing on high quality companies that have sustainable cash flow and dividend streams, we believe that we can really harness the power of those dividends. So thanks for your time today, and we'll see you next time.